the most common investing mistakes and how to avoid them.
Hello and welcome back to the Future Value Podcast. I'm John Pellosie alongside Joe Freemont and Justin Ahner. Today, we are continuing our conversation about investment fundamentals. And specifically today, we're talking about avoiding common investing mistakes. These are things that we have seen people fall victim to time and time again, and they are extremely, extremely common. So our goal today is to examine a few of these, really help people understand what the issues are with these mistakes, and then, of course, how to avoid them and make sure that they are investing in the most rational and the best way possible. So, Joe, I'm going to turn to you to talk about our first common investing mistake that we often see, and that's the idea of market timing. So can you talk to us a little bit about this phenomenon?
You got it. I mean, if you go online at all and you see, how do I invest, right? We've already talked about asset allocation and location, but one of the first things that you might see online is buy low, sell high. It's almost investing 101. I want to buy the stock at the lowest price as possible and sell it at the highest time possible, right? And that idea of, can I time the market to be at the best and worst case, right, is really a dangerous idea, right? Because it insinuates that really you got to be right twice, right? Not only do you have to have a crystal ball that says, hey, I know exactly when the market is going to be at the lowest point, but you have to go around and turn around and say, hey, I know exactly when it's going to be at the highest point, right? And we've seen a lot of market movement recently, and it's really a dangerous mentality in the sense that you might pick the wrong time, right? Even as financial professionals, we don't know when the market is at the highest highs and the lowest lows. And if we did tell you that, you might want to turn around and run the other way, right? So the concept is that I'm going to buy at the lowest point and I'm going to sell at the highest point. And I know exactly the right time. But I think the trap that a lot of investors get caught in is that we do not know that, right? And also, a lot of the best times in the market tend to be right after the worst days in the market. So when I think of that, I think of the common investor. What if I sold out of all of my holdings because you know what? The market was down because of X, Y, and Z. And I just really couldn't take it emotionally that my accounts were down that much. And I said, you know what? I'm going to wait a couple months and I'm going to get back in when the market is doing better, right? Well, what if the market, not even a week later, rebounds 5, 10, maybe 15% in such a short time, and I'm here sitting in cash? Well, I locked in my loss. The analogy that I like to use is I got on a roller coaster ride and I took my seatbelt off halfway through the ride, right? So the best days will follow, or at least historically have followed the worst days in the market there.
And I think when I think about the idea of timing the market, I think the issue that I see is, there's so much noise and media noise around people when they do it right once, especially on the professional money management side. We hear about people who successfully forecasted the financial crisis in 08 and 09, and so they made a lot of money in that situation. But the reality is, a lot of times those same people miss other events. So just like anything, anybody could be right once. It is very, very, very difficult, if not impossible, to do that over and over again. And I think, to your point, Joe, part of the reason is because it's kind of a hindsight issue, right? How do you know that we hit the bottom of the market? Well, when we're already heading back up. And the same thing the other way. How do we know that we hit the peak when we're on the way down? So you really can't know. It's unknowable where we are at unless we're looking in the rearview mirror. And I think that's an important thing people need to understand.
I heard 2 great points from you there, John. One is, I think we all have that relative or that friend that tells you about their big wins when they're investing, right? But you know what they conveniently leave out when they tell you about their great win in investing? All the failures that they had before that, right? Everyone wants to tell you, oh, I made so much money on XYZ stock. But they don't tell you about the 10 other stocks that failed and either bottomed out or they lost on their original investment. But I think another point that you brought out, John, is that I think we need to be very careful in our investing journey that we're not gambling on the stock market, right? Some people might think that it might be gambling, but we're investing in fundamentals and owning stocks and corporations, right? There's real company assets behind it, right? And I think it's very dangerous to say, hey, I'm going to buy low and I know it's going to go up very, very high, right? Or count on that in the short term.
Yep, I agree.
I think that's an interesting point, Joe, that you bring up about gambling, because oftentimes investors will get excited about that. I'll share personally, actually, I traded options for a little while, and that was like gambling. You get that high when you get when you think you knew what was going to happen and something may be positive. I have a couple buddies that still do that kind of thing, and like you said, it's great to post like, hey, I was up 15, 20% on this bet, essentially. But you're right, Joe. It's like regular gamblers too. They like to tell you when they're up, but they won't tell you when they're down.
And I think to put a bow on it, you two of you said it perfectly. There's a difference between being an investor and being a trader or a gambler. And I don't begrudge anyone if they want to do that trading on the side, and like that's a form of it's a form of gambling. It's a side piece for them. They like that excitement. That's great. I mean, I like to go to the casino every now and again too. There's nothing wrong with that. But that's different. I would say we have to treat that differently and not think that is the core investment philosophy, right? Investing is something very different. Definitionally, as we've talked about, I think before, investment is the long-term deployment of capital toward a productive end. So the long-term piece is really important.
And I think from a financial planner's perspective, we like the KISS method, the keep it simple method, right? Your investing should be automatic and easy, right? Because if you take out the emotional variables of, oh, I'm going to time it at the bottom or I'm going to sell at the top, and you keep it consistent, you're going to end up good because you're building those strong behaviors.
Yep, absolutely. Speaking of that, moving on to maybe the next issue that we see is that idea of getting sucked into the short-term returns, or maybe what we call short-term volatility. So, Justin, I'll ask you a little bit about that. Kind of, have you experienced that with folks? Have you ever had to have conversations with clients on that difference?
Yeah, absolutely. I mean, clients, they get nervous sometimes, as Joe mentioned earlier. They're on that roller coaster ride, and it's fun and exciting when you're going up. But lots of people get nervous when it's coming down, and unfortunately, sometimes folks do jump off the roller coaster on the way down. Mm-hmm. And I think it's our job as advisors to be that safety belt, to really try and help keep our clients on the ride. Don't jump off at the bottom. Don't get hurt. And really trying to focus on the long-term picture, which, as you just mentioned previously, is really the ultimate goal for most investors. So I think it's important to consider, again, what's your goal for the account? What's the goal for investing? If we want to see those returns long-term, we need to be okay with stomaching some of that short-term volatility. I know it doesn't always feel comfortable. Sometimes it could even be a little scary when you see the markets down, double digits in days or weeks. But fortunately, for us buy and hold investors throughout history, we've seen that ultimately it does continue to go up.
Absolutely. And I think what's important for especially newer investors to understand is when we talk about the long-term, returns of investing in the stock market, we'll hear long-term, maybe the average is somewhere between 8 and 10%. I think that's an often cited figure. It's important to remember that doesn't come as a one-year return. You're not getting 10 and 10 and 10 and 10. When you're investing in stocks, you're getting plus 20, plus 30, whatever in 1 year, and then you might be down 20 or 30 or 40 or more in another year, right? Just as you were saying, Justin, it's a roller coaster ride, but we have to be willing to ride the roller coaster if we want to get to that long term. So again, I think people really do need to understand that when we talk about your average return, there's going to be a lot of variability to it. The other piece is when we talk about just watching how the market's performing over different time periods, it's really fascinating to see. And we'll throw up a chart here for our audience to take a look at. But you can see the over time how often the market is up versus down. On a day-to-day basis, it's basically 50-50, right? If you look at the stock market overall, if we use the S&P 500 as an example, basically one day it's up, one day it's down, one day it's up, one day it's down again. It's a 50-50 on a day-to-day basis. As we start to stretch out the time period, a month, a year, multiple years, we get to see that probability of positive return goes up significantly. And when we get out to very long time periods, multiple decades, basically it's 100% positive return. So again, it's that shift in mindset, not focus on the short term as much, but I think more about the long term, again, based on your objective for the account.
So John, what I'm hearing from you, would you say that volatility is normal then when you're investing?
Oh my gosh, yes. It's not just normal, it's necessary if you want to get the higher returns, right? If we didn't need to take on that risk, we wouldn't be investing. We also wouldn't be getting the higher return, right? So if we want to do better than we can do in the bank, it is extremely normal to have volatility. In fact, I would say it's probably not unusual in any year, positive or negative, to see double-digit volatility in the stock market at some point. But it is normal and necessary to get to the higher levels of return that people want when they're investing in stocks.
Great point, John. I actually think there's a really cool case. So a lot in our day-to-day work, we're reviewing our accounts with our clients, and there's a particular chart that we show them on some of our investment accounts that shows them the history of their investing journey with us, right? So we show them their net investment, the amount of money that they've put in versus the money that they've taken out. And then we also show them what the market value is of that account, right? And we show them over the years how they've done and how they have performed, right? But something that we notice over the term of the investing journey is that in the beginning, that market value is very close to what your net investment is, right? And that's because of that long-term mentality that you have to have, right? If at some points in the beginning stages, we might be very close, if not maybe even negative to the net investment. But it's that long-term perspective, John, that you mentioned that makes it all worth it.
Absolutely. So I think as we go on now to look at a couple more investing issues, I think probably at a high level, a number of these fall under what we might be calling behavioral finance issues, right? So there's a number of these. And Justin, I wanted to start with you. Could you give us some examples when it comes to how human behavior itself might cause some issues in investing?
So there's always downswings in the market. It's not unusual to see, single digit, potentially even double digit downswings, even in a positive year. And folks may latch on to that. Oh my goodness, we're down and we're going to continue to go down, and not really considering the full picture.
So Justin, on the flip side of that, so let's say you would say past historical performance is not indicative of future performance. Is that what you're saying? Right? So ABC stock that has done so well for me over the last years isn't going to keep up that track record all the time?
Not necessarily, no. I mean, and that's a great point, Joe. It works conversely as well. If things are going great, we may become a little too confident in that. And actually, I think that leads well into the next bullet point here, which is overconfidence, where you're saying, hey, the markets have been doing really good in the last 2 years. We've seen double-digit returns. ABC company has been doing really, really well. And without diving too much into the fundamentals, you may be saying, hey, we're doing great. We're going to continue to do great forever and ever. And again, that's not necessarily true.
So, John, could you take us more through maybe the market cycle on a typical, call it maybe 5 to 7 year period of how many years might be up statistically versus down?
Yeah. I mean, what we've seen over the long term is that on average, 75% of years, the market is positive, and 25% of years, market is negative. I'm talking about calendar years here. Of course, there's a lot that goes into the time periods you're measuring and that sort of thing. So that can factor in. But on a calendar year basis, the market is up more than it's down for sure. Again, it goes back to, I think, as Justin was saying, not becoming overconfident or complacent. And often what I've seen is sometimes folks will do the opposite of buy low and sell high, right? Buy low and sell high is that's the textbook way to where we're going to make money in investing. But in reality, what often happens is people get into an investment, it does well for them, and they won't ever sell it, no matter what. And that can be a problem, especially if they're really concentrated in it, right? A particular sector does very well, or a particular industry is doing really well for them, and they become, I would say, not open to making changes to that, even if there looks like there's going to be some reversals in that industry. And then the same thing on the other side, as you were pointing out, Justin, is that people might focus on a particular stock that hasn't been performing as well on their account, and they'll say, I got to get rid of this thing. I'm going to end up selling low, right? So I think that's the issue when it comes to market cycles too, is just people getting a little bit, people becoming overconfident, thinking that the status quo is always going to remain the same, and they can stick with what they've always been doing, especially if they've been concentrated in only one small stock or a handful of stocks.
Awesome. I think you brought up a great point there, John, and I think it leads us to our next common investing mistake, which is anchoring, or kind of what I would call the sunk cost fallacy, right? So we think of sunk cost fallacy when we think of cars mainly, right? How much money are you putting into the car when what is it actually worth? Well, in terms of investing and anchoring, we're thinking about what did we buy the stock or the fund at versus what it is, right? So in, let's say, ABC stock, I bought it at $100, right? Well, now it's down, 40%, it's now worth $60. Well, I believe so firmly that I don't want to lose money on my ABC stock that I'm willing to wait way too long or not in alignment with my goals originally for that purchase of the stock, right? I'm not going to sell it because I need to at least make my money back.
Mm-hmm. Yeah, I think, again, that's a great example of where investors kind of stop being rational,
right,
and data driven, right? It's just a human flaw, right? You're making decisions based on a reference point, an arbitrary reference point, rather than facts and information and the forward looking. And investing is always about forward looking. Mm-hmm. It's about what's going to happen, not what's happened in the past. And I think that's an important thing to remember too.
And you don't want to have the fear of missing out, or FOMO, right? I think that's a big one for investing, right? Raise your hand if you've heard of if I only had just bought XYZ fund back in 2020, I would be doing so much well right now. Almost every day.
Right. Right. It's classic. I bought Apple back in the 80s or 90s. I bought Microsoft. And, but that's the thing, right? Like, not many people did that. And that's why people are famous for getting rich on the stock. But I think it's, honestly, I think FOMO is probably one of the biggest challenges, especially for folks in their 20s and 30s, that we face financially across the board. And investing is no different, right? You hear about your friend who invested in, XYZ or whatever the latest and greatest trend in investing is, and it's done so well for him. And it's tempting to feel like you missed the boat on something, or I got to get out. I know I've got this plan over here. I got this really well-diversified, thought-out portfolio. I know everyone says if I stick with this, it's going to do well for me. But man, that thing over there, that's pretty cool. I got to get into that. And again, I think that's the temptation. The temptation is to move out of what has been created, set up, done thoughtfully by you and your investment to kind of chase the latest thing. And that's even an issue just in itself. Maybe you could talk about that concept of chasing returns, as we sometimes call it.
That is really an issue, as we were just talking about. Folks have that fear of missing out. They may see that something is gaining traction. Certainly in recent time, cryptocurrency has been one of those items where there's really not a lot of rational data for the reason that it's gaining value. It's more so people think it's valuable, so it's creating value there. Oftentimes we'll see that a lot with individual companies where maybe it may be lowly valued now, but maybe they come out with a new technology, something cutting edge, and all of a sudden everybody's, I got to get in, I got to buy. And you may see a huge increase in the value of that stock. As it's going up, 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 people continue to buy, and keeps driving the value up more. And there may not actually be a reason or an underlying data for that to happen. And that could potentially turn into a problem. Because if the company is overvalued because of people with the fear of missing out, they continue to buy. Unfortunately, the rug may be pulled out from underneath of them at some point when the data is more important than the FOMO.
So would you say that the grass isn't always greener on the other side, Justin?
Absolutely.
Excellent. Well, I think to me, one of the most powerful things that I learned about when it came to investing is kind of the culmination of all of these mistakes. And that's in what we sometimes call the investment behavior gap. And Joe, maybe you could take us through a little bit of what does that mean when we're talking about this gap?
Yeah. So everybody opens up that first investment account at some point, whether that's during college or you're opening up your 401k or IRA. And you might say, well, I look at popular indexes and I see maybe such as the S&P 500 or the Dow index. And then I look at my investments and why am I not getting the same return as the indexes that I'm seeing? If I hear that the market is up 25% this year and I'm only up 20, what's the difference, right? And the difference, and not to get harsh on the average investor, but the difference is the behavioral stuff, right? Because maybe you saw that the market was down at one point and you chose to sell out. Or maybe you weren't as consistent as you were intending to be, right? The emotional or behavioral differences in the human aspect of it might change your performance compared to the index.
Absolutely. And I think, Joe, to me, what's really interesting about it is there's no one to blame except the investor, right? So you can't be like, man, I picked the wrong investment. This investment hasn't done good. There's been so much study over this where they compare apples to apples. They say, hey, the people who were invested in this fund, how did they do? And how did the fund itself do over that same period? And we'll share some information with our audience here, which they can see. But, this has been done repeatedly over different time periods. In certain time periods, like a 30-year time period, it could easily be that the average investor's performance was half of what that actual investment itself had done over that same time period. So they're giving up over half their performance. I think for me, when I look at that, again, that's a culmination of all of the mistakes we've been talking about. It's people buying high and selling low, doing the opposite, getting scared out of the market because of volatility, losing focus on the long term, and all of those different things. And that it really culminates to that cost. And I would say, Justin, a question for you would be, if somebody hears that and they are wondering, okay, how do I avoid that gap? What are some ideas you might have for that?
Yeah, staying consistent. As Joe was talking about earlier, it's sticking to a plan. If you're gonna invest, have a plan. Say, hey, I'm gonna put $100 or $200 a month away every month. Not, oh, the market's really high, I'm gonna stop buying in because I think it's gonna go down. Or conversely, I'm really gonna shovel a bunch in now because the market's down and I think it's gonna go back up next week. Sometimes you may get lucky and it may work out to your benefit. But oftentimes it's sticking to that plan, being consistent, and being consistent over a long period of time.
I would add one point to that, Justin, which is think about why 401ks are usually the primary retirement account that the individuals have that has done the best over their careers, right? It's because every time you get paid, you have agreed to put in a certain percentage. Hopefully you're putting a certain percentage in your 401k account, right? And you're getting that match. The consistency of getting paid once a month or bi-weekly or bi-monthly, that is the consistency that we are talking about. They make it very simple. In fact, you don't even see the money, right? Mm-hmm. Hopefully you're looking at your account every once in a while, right? But that is that automatic, keeping it simple type of mentality that you need to keep going through and avoid these behavioral mistakes.
It's interesting you mentioned, I do agree. I think people should take a look at their 401k and their investment statements every once in a while to make sure things aren't crazy. But it is interesting. There was some studies done that showed if people were checking their accounts, and specifically their 401ks, if they would like check it excessively, maybe every day or every week or whatever, there actually was a correlation with lower performance because those people were more tempted to make adjustments to the investments, right? React to short-term events in the market, and it actually hurt them. So I thought that was interesting. There's a concept of, that the money is kind of this tricky thing, especially in investments, where sometimes the more it's handled, the less of it you end up with over time. And I would say one last thing about that behavior gap is, if somebody says, I really want to be sure that I don't fall victim to these different errors, I think that's where, professional financial advice can come into play too. Obviously there's going to be a cost associated with that, but, a good financial advisor who's charging you perhaps a percentage of your assets under management or things like that, can provide a lot of value. They can provide value in setting up the asset allocation. They can provide value maybe in some tax strategies too. But really, I think one of the biggest values I've seen that a financial advisor can bring to clients are those moments of crisis, right? When their account is down 30 or 35 or maybe even 40% because they're invested in the stock market and the market's volatile, having the advisor who's there to help make sure they don't make a tremendous financial mistake. To be that one person that says, basically, that says no says, no, we have a plan. We got to stick to the plan and make sure that we execute it for our long-term vision. That can create tremendous value for a client. So I wanted to mention that.
Be in the seatbelt on the roller coaster.
Oh, yeah.
You be safe.
Well, if you liked anything that you heard today, we want to make sure that you hit that like button or hit subscribe on our YouTube channel and podcast platforms so that you don't miss a single episode of the Future Value Podcast. And from all of us here at the Future Value Podcast Show, thank you for tuning in.